Chapter 11, Monetary Policy. Section 2, Tightening versus Easing. Monetary policy usually moves in one of two directions, tightening or easing. Tightening is meant to cool demand when the economy is running too hot, while easing is meant to support demand when growth is weak. The simple part is the direction. The hard part is judging inflation, jobs, growth, and financial conditions all at once. Central banks tend to tighten when the economy looks overheated and inflation is rising above target. That can happen when spending is strong, credit is expanding quickly, and asset prices start to look a little speculative. The goal is not to shut the economy down, but to bring demand back into better balance. Tightening works by making money and credit less easy to get. A central bank can raise policy rates, sell securities, or require banks to hold more reserves, and all of that pushes borrowing costs higher. Over time, pricier mortgages, business loans, and consumer credit tend to slow spending and investment, which helps reduce inflation pressure. Easing is the opposite move, and it usually shows up when the economy is weak. If unemployment is high, growth is soft, and inflation is too low or still falling, central banks may try to support demand before the slowdown deepens. The aim is to encourage spending, hiring, and a healthier pace of activity. Easing lowers the cost of credit and adds liquidity to the system. That can mean cutting policy rates, buying bonds, or lowering reserve requirements so banks can lend more freely. The idea is simple. Cheaper loans can encourage households to spend and businesses to invest, even though the full lift takes time. The choice sounds straightforward in theory, but in practice, it is rarely easy. Policy acts with a lag, so central banks have to respond to where the economy is headed, not just where it is today. Tighten too fast and you risk a sharper slowdown. Ease too much and inflation or asset bubbles can build, and credibility affects how markets react to either choice. Once a policy decision is made, it moves through the economy in stages. Banks reprice loans and deposits, borrowers adjust their plans, investors change how they value assets, and expectations begin to shift. That is why the broad effects on growth and inflation often take 6 to 18 months to become clear. A recent example of tightening came in the United States in 2022. Inflation had climbed to about 8.5% while unemployment was still low, so the Federal Reserve raised rates from near zero to above 5%. Inflation later fell to around 3%, but the process also brought higher mortgage costs, a cooler housing market, and some financial strain. The euro area offers a clear example of easing. In 2014 and 2015, inflation was under 0.5% and growth was very weak, so the European Central Bank cut its deposit rate below zero and used bond purchases to support demand. Those steps helped lower borrowing costs and support activity, though they also raised concerns about bank profitability and risk-taking. A few trade-offs are worth keeping in mind. Tightening does not bring inflation down immediately, and easing may not be strong enough on its own during a deep downturn. Direction also is not the same as strength, and central banks still have to think about exchange rates, financial stability, and the side effects that come with every policy move.